The calendar had been circled for weeks. Inflation prints had already rattled markets. Bond yields were sitting near highs traders hadn't seen in years. Every central bank appearance now felt radioactive. This one felt worse. At 7:10 a.m., New York time, desks were already awake. Not trading, preparing. Forex dealers closed scalps they normally let run. Futures traders halved size. Options desks paid up for hedges that only made sense if something went wrong. Crypto funding rates drifted lower as leverage quietly slipped out of the system. Everyone pretended it was routine. Nobody believed that. In a one-bedroom apartment outside Chicago, a trader rolled his shoulders in front of 6 monitors. Former engineer, part-time futures trader, 2 funded accounts, 1 personal. He hated Fed days, but he hated sitting out even more. He trimmed positions, left only what he considered balanced: a euro-dollar spread, a small NASDAQ short, a treasury hedge, call options he'd bought days earlier when volatility was cheap. On paper, it neutralized risk. On paper is where disasters always start. Across town, inside a glass tower overlooking the river, a rates desk stared at yield curves bending upward. 2 senior traders argued in low voices. Were officials about to lean harder or signal a pause? One junior refreshed positioning data: crowded shorts and bonds, retail long equities, options dealers stuffed with short gamma. The system felt tight, compressed, a spring under load. In Florida, a prop firm scalper watched his dashboard flash yellow. Daily loss limit. 3 accounts linked. If one blew up, the rest could follow. He promised himself he'd cut size. He didn't. Liquidity looked fine. Too fine. That's always when traders convince themselves the danger has passed. On Discord servers and Telegram rooms, the arguments had already begun. Flatten before the statement. No, the first move is fake. Rates matter more than stocks. Crypto won't care. Someone posted a screenshot of a massive bond trade crossing overnight. Someone else claimed a leak. Nobody verified it. Everyone believed the part that fit their position. By 8:20 a.m., the atmosphere thickened. Quote slowed. Market makers widened a hair. Not enough to scare anyone. Just enough to notice. That's the part veterans fear most. When liquidity doesn't vanish, it hesitates. In Chicago, the engineer hovered over the flatten button, closed 1 micro lot, left the rest. Told himself the hedge was enough. Told himself he'd be quick. Told himself a lot of things. 8:30. The statement dropped. Treasury futures jumped, then collapsed. Euro-dollar spiked 12 ticks, then reversed 20. NASDAQ froze for half a second, then printed 3 prices at once. Green, red, green again. The engineer tried to cancel his short. It filled before the order window refreshed. Liquidity had vanished between frames. At the rates desk, a trader muttered, "Dot plot's ugly." 2-year yield surged. Stocks ripped upward. Algos shredded order books faster than humans could read. Risk columns flickered yellow, then orange. Crypto lagged. It always does. Chat rooms filled with capital letters. Futures moving. Bonds just broke. Wait for Bitcoin. Then Bitcoin detonated. $50, $100, $300. Perpetual swaps cascaded. Liquidations tripped stops that triggered more liquidations. Altcoins followed like debris in a flood. The second candle arrived. Wider, faster. The engineer flattened his euro. The stop triggered. Late. 8 pips. It felt like 80. His NASDAQ short ballooned. He hedged. The hedge slipped. Then his options helped. For 30 seconds. Volatility collapsed. The implied volatility spike turned into implied volatility crush. The protection melted while price kept climbing. In Florida, the prop trader took 2 losses in a row. Daily drawdown warning. He closed, got slipped, closed again. Another slip. The red number blinked. System calculating. He waited to see whether his account survived. At the rates desk, a risk manager stood behind chairs, hands folded, not shouting, watching. That silence scares professionals more than yelling ever could. The press conference started. That's when the real damage usually arrives. A reporter asked about inflation persistence. The chair answered carefully. Too carefully, yields ripped again. Stocks buckled. Crypto stuttered. Another wave. Terminals exploded with headlines. Fed sees higher for longer. No cuts near term. Risks tilted up. Social feeds did what they always do. Turned nuance into war. Screenshots of P&L bounced across chats. Green turning yellow. Yellow turning red. Some traders slammed flatten. Others froze. Both choices hurt. In a suburban office outside Phoenix, an options trader stared at exposure graphs, flipping sign. Dealer gamma had gone negative. That meant hedging flows were now accelerating the move. The market wasn't calming, it was feeding on itself. In Chicago, the engineer flattened everything. Messy, expensive, but alive. The balance shrank, a lot, still positive, barely. In Florida, the prop account closed itself. Daily loss limit breached. Evaluation failed. 4 months of fees erased in 7 minutes. Across the country, a retail Forex trader refreshed his frozen platform. Market order filled 2 seconds later. 20 pips worse. He stared at the timestamp. The market had moved without him. By mid-morning, the candles shrank. Spreads narrowed. Liquidity crept back. Chat slowed. Desks exhaled. The damage was already locked in. That afternoon, emails arrived. Margin increases. Intraday leverage cuts. Prop firm rule changes. Volatility protocols activated. Accounts flagged for review. In Chicago, the engineer replayed the session bar by bar. Every hesitation, every late hedge, every assumption. He wrote 3 lines in a notebook. Flatten before statements. Reduce size more than feels comfortable. Assume liquidity can disappear. In Florida, the prop trader priced another evaluation. Didn't rage, didn't swear. Just stared at the number. Calculated how many perfect days it would take to earn it back. At the tower, the rates desk logged the day as disorderly. That's the institutional word for violence. Headlines tried to explain what happened. Dot plots, guidance language, forward curves. But traders remembered the simpler truth. When central banks speak, everything listens. Stocks, Forex, crypto, options, futures. All roads run through rates. Markets would move again. Another CPI, another emergency meeting, another surprise. The only question, would the traders be positioned for it next time? Here's the tonic. Macro days don't reward bravery, they reward survival. They punish assumptions, they expose leverage, they reveal how fragile diversification becomes when correlations snap. When the Fed speaks, you're not trading your setup. You're trading the entire financial system, whether you meant to or not.